Time to look at your market news now. The dollar extended its losses as a surprisingly low reading on U.S. inflation stoked speculation that the end of the post-pandemic tightening cycle is in sight. Stocks and currencies in Asia rallied on growing risk appetite. Chinese tech giants listed in Hong Kong rallied after Premier Li Qiang met with senior executive from the country's leading technology firms, adding to signs that a years-long crackdown on the sector is over. Meanwhile, locally, the rand briefly crossed below 18 rand to the dollar, and we have 12 out of 21 economists polled by Reuters saying that they expect the South African Reserve Bank to keep rates steady at 8.25% next week. The remaining 9 said they do expect interest rates to be hiked by 25 basis points. To look further at the markets and unpack the U.S. inflation figures, we are joined by Han Tan from Xfinity. Han, thank you so much for your time. Your initial thoughts on that CPI report and whether you found anything encouraging in that data?
Oh, yeah, I think overall there was an encouraging sheen to the data that we got yesterday, especially the core numbers, because at 0.2% for month-on-month core, that's what the Fed needs to bring overall inflation back down closer to its 2% target. So and yesterday's numbers also strengthens the case of the Fed achieving the soft landing, much to perhaps some of the market doubts that even I myself had this year. So, even if there's a recession, it may not be a deep one as long as the jobs market keeps holding up while inflation cools.
On that note, then, are we ready to call July the last hike?
Yeah, so markets appear to think so, for now at least. Currently Fed funds futures pretty much fully expect that hike later this month to be the last, because after that, there's only about a 13% chance of another rate hike by the Fed after July, right? Now, of course, the Fed may yet ramp up their hawkish rhetoric at their meeting later this month, but then the obvious question posed by markets will be whatever for, right? Because as we've seen, inflation is slowing, so why risk a deeper recession if inflation is cooling with more rate hikes, right? So I think ultimately it all boils down to what the Fed actually conveys to the markets at their July 26th meeting.
So I mentioned in my intro, you have the dollar sliding to its lowest level since we've seen late, probably last year in April. What do you believe will set the tone for the dollar for the remainder of the year?
Yeah, indeed. So keep in mind that while markets also, hope that the end of the Fed rate hikes is near, well, how long do we see peak interest rates being maintained at those levels, right? Because recall that earlier this year, there had been expectations for rate cuts. Those have been pushed out into around May of next year. So now whether or not those expected rate cuts for May 2024 and beyond actually materializes, I think that could be the next deciding factor for the US dollar, at least on a rates differential basis. But of course, risk sentiment also plays a part into it. If we do see a global recession and a deeper than expected one, then I think more safe haven bids on the dollar could come back and prove the dollar smile theory to be true once again.
Your thoughts on the shape of the yield curve at the moment?
Yeah, so if you look at between the 2 years and the 10s, it's still around the most inverted since the early 1980s, right? Although to be fair, there has been some slight recovery of about 30 basis points so far this month. But overall, it tells me that the markets are still bracing for the Fed to keep those interest rates higher for longer, right? So on the other side of the coin, that implies that those hoping that U.S. rates can be slashed by half from current levels by 2025, I think they could be disappointed by how limited or how little room the Fed can actually cut rates perhaps starting next year.
So we have earnings season kicking off with the banks tomorrow. Your expectations and what are you going to be paying close attention to?
Yeah, for us, I think overall it's still very much tech-centric. I think earnings out of the IT sector and also energy sector as well, I think those should help prop up earnings overall out of the companies on the S&P 500. Although to be clear, for Q2, there is a contraction expected, right? But then having said that, markets are always forward-looking in nature. As things stand, there are hopes for an earnings rebound for the final quarter of this year. And of course, we'll get those numbers in early 2024, right? So I think it's the guidance that we'll get out of the C-suites over the coming weeks, that will set the tone for markets, not just for Q2 earnings, but beyond as well.
Before I let you go, if we were to have a slowdown, what would that mean for risk assets?
Yeah, so if it's a slowdown, but still perhaps sluggish growth, it is still growing. So that's still better than the much feared scenario perhaps many had expected coming into this year of a deeper recession, right, on the back of the very aggressive rate hike cycle by the Fed. So slow growth should still be fine overall. I think it then adds a supportive element, especially for, say, stocks that are more exposed to the real economy, and on top of the AI mania, provided that frenzy around AI that still persists. So, it should be, supportive for stocks. But if you look at, say, oil prices or FX markets, slow growth, especially for the US or the global economy, may not mean as much upside for these other risk assets.
Han, unfortunately, we have run out of time. I would have loved to ask you whether we can actually live with a figure somewhere close to 2%, given that the road to 2% could be a little bit longer. Not sure how long, but also what that would mean for markets in the meantime, and whether the Fed would live with a figure of inflation that is close to 2%, but not quite at 2 just yet. Han, thank you so much for your time this afternoon. That is Han Ten, who's the Chief Market Analyst at Axinity.